Okay, so today's video is the fifth in our series that we've entitled Huge Options Trading Blunders. We've decided to produce this series for traders who are really serious about trading options for a living and badly want to succeed, but they keep getting sidetracked by dopey ideas with huge flaws in them instead of taking the proper steps to excel as an options trader. I'm the head trader of SMB Capital's options trading desk, and I can tell you from many years of experience that I've seen that every one of the mistakes that we're going to be describing in these videos, they're real. And if you're serious about trading for a living, you really need to pay close attention to these videos so that you can avoid serious problems in your trading journey. So if you're committed to trading full-time as an options trader, then I urge you to watch this video and the rest of the videos in this series so that you don't fall by the wayside like so many aspiring traders who don't want to spend the time to learn the actual truth about the rewards and challenges of the options trading and the skills you'll need to truly succeed. We want you to take a realistic path to your trading goals, which are attainable if you're serious and willing to put the work in to succeed. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so today we're going to be looking at options trading blunder number 5 in our series on options, misconceptions, and huge mistakes that you can make as an options trader. So blunder number 5 starts out, as most of these blunders do, with a true statement that unfortunately has a hidden downside that you need to think through, but most people don't. And that statement is this: the market won't go down forever. It will eventually bounce, no matter how bad things get. And historically, that's of course true. Even in the depths of the Great Recession of 2008 and 2009, the market did eventually bounce. In fact, it did so in March of 2009, and the current bull market has pretty much remained intact ever since, with a few short-lived corrections in the mix. Now, in order to explain how this leads to an options trading blunder, I need to make sure you're familiar with the basics of how index options work. If you know something about options, don't worry, this will be quick, and then we'll jump into the core of the lesson. Now, almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is get paid cash, $100 per point if the index expires before the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So, for example, if an index is trading at 1400 and you buy the 1410 call, if the index goes to say 1415, you'd receive $500 in your account. If the index closes at 1410 or lower, your call expires worthless. On the other side of the ledger, if you buy a 1385 put and the market sells off to 1375, you'd make $1,000. But if the market just sold off to 1385 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will also allow you to sell options. And your broker will allow you to put together combinations of options. In other words, options strategies that involve both long and short options purchased in a way that is advantageous to you as a trader. Okay, so now armed with that knowledge, let's talk about this idea, which some option traders have, which seems so amazing on the surface, yet it's so incredibly insane and dangerous once you start digging into it a little bit deeper. So let's drill down a little bit deeper about the fallacy that we're highlighting in today's lesson. And we can do that through a vivid example from the real world that could have taken place very easily in the past. One of many examples that I could have shown you today. Okay, so let's go back to August 17th, 2015. Now on that day, let's suppose you said to yourself, hey, I think I'd like to pull about $3,000 out of the market over the next 12 days because Valentine's Day is coming up and I need the money or for whatever reason. So you figure, well, I know something about index options. So let's see, on that day, the S&P 500 was trading at around 2100. So if I go in and sell 10 of the 2040 puts expiring in 12 days and the market closes at or above 2040 in 12 days, then I walk away with $3,450. Why? Because the option sells for $3.45, but the option obligates you to pay $100 for each point below 2040 if the market sells off. So you multiply that price by 100, and since you sold 10 of them, you collect a total of $3,450. Now, if the market closes above 2040, then you have no obligation to pay anything, because the deal was that you'd have to pay $100 for each option for each point below 2040. So any closing price of SPX above that means that the option expires with no value, no obligation on your part, and you just walk away with $3,450. So that was your Valentine's Day plan. Now, because of the risk that you're taking on with these 10 puts, your broker is actually going to require you to have $255,000 in your account to make sure that if there's a really big move down in the market, you could be obligated to come up with a large amount of money to pay for your obligations for those 10 puts, and that money needs to be in your account. Now, in options trading, there's a concept called delta, and it is defined in different ways, but it roughly equates to the probability that you'll actually have to pay off on options that you sold. So if an option has a delta of 20, then there's a 20% chance that the option would expire in the money, which would be a bad thing because then you'd have to pay off on the option you sold as opposed to just walking away with the money that you got for selling the options. You don't have to figure it out on your own, incidentally. Every major options broker will tell you the delta of any option for you on their platform. So anyway, let's say your system, which would be a very common system, let's say that your system is that every time the delta of your option gets up to 20, then you'll buy back that put and roll it down to an option on that same options chain that is now a 10 delta option, which is safer and farther away from the market. And because at that point you'll almost always be down money on the trade, then you'll have to sell more options in order to be able to make money on the trade at the end of the day. So at this point you might think, well, hey, if the market sells off, that's okay. I'll just roll my options down to a lower strike and sell enough options at the new strike to still be able to make money on the trade, right? So, I mean, I really can't lose ultimately, can I? I just keep rolling down till I win, right? I mean, the market will eventually bounce, right? It always does. In other words, you'll get lured into options blunder number 5, which says, I'll always win eventually if I keep rolling my short puts down, right? And this is a very common belief among beginner option traders. Now, before we explain why this idea, which seems so logical on the surface, is actually completely and utterly insane and will never work, I wanted to let you know that there really are sound techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of the strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you could employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. So let's get back to our example. So we sold those 10 puts at 2040, 12 days out from the expiration, and now let's move forward to August 20th. Now on that day, the market opened up down sharply. Most traders will wait till about 10:30 to make moves on their options income trades. And so in this case, the 2040 options had actually moved up to 41 deltas, which makes sense. Now that the market's at 2052, the 2040 options we sold are only 12 points away with 9 days to expire. So it shouldn't be surprising that the chances of those expiring in the money have now risen to 41%. So with our protocol, once we get into the area of 20 or higher, we have to roll the options down to closer to the 10 delta options at that time. So let's take a look at what happens next. It's important to understand this. So our protocol dictates that we must buy back the 2040 puts. Well, those have really increased in price because now they're so close to the market. So the one selling them is now taking on a huge amount of risk if there's a 41% chance that they'll have to pay off. And so to close those short positions and buy those back is going to be very expensive. And in this case, it's $16.25. But remember, you only sold those for $3.45. So to roll your puts is going to cost you a lot of money. So now you'll see that we rolled down, but we also increased our size to 35 put options. Now it's crucial for you to understand why we had to increase to 35 put options. So remember, we originally received $3,450 for the 2040 puts. Well, to close them and roll them down, we're going to need to pay $16,250. Now, if we roll down to the 10 delta options at the 1975 strike, you'll see that they're priced at $3.95. So even to get back up to about just $1,000 of cash flow, you need to buy 35 of them, because much less than that, and you don't even overcome the deficit from the first roll. Well, now the market would have to drop a lot to hit those 1975 puts, but still you've taken on the risk now of 35 puts. So now your broker is going to require a ton more capital from you, and in fact, you'll need over $819,000 of capital to roll down. And we've just gotten started. So yes, it's possible to sell enough puts to have positive cash flow, but it requires a lot more capital than the original trade. Now, let's move forward to the next day. You'll see that the SPX has now sold off again, this time down to 2015. So that has pushed our 1975 puts to 27 deltas, so it's time for us to roll those down again 50 points to the 1925 strikes, which are 115 points below our original strikes. So now let's take a look at why we had to sell 75 of those. Well, remember, the deficit from the first roll was 12.8, but we brought back in 13,825 from selling the 35 puts. But now to buy those back, as the market has sold off so dramatically, we will need to pay $12.15, and we've got 35 of them to buy back this time, so it will cost us $42,000 to buy those back and roll them down, and now it will take us 75 options at the 1925 strike to make up all of that loss from the previous rolls and still be able to eke out about $1,000 from the trade. But now that we're selling 75 options, our broker is going to require us to have in our account over $1,616,000 because of the much larger risk of this trade. So by now, I think you may already have figured out where this is going, and I won't go into as much detail on every roll, but just quickly, at the end of that same day, August 21st, we had to roll again. And this time we had to roll down to the 1800 strike and sell 218 puts just to turn our cash flow positive again, because at that point we were down $154,000 on this trade, and now our capital requirement has skyrocketed to over $4 million. 3 days later, the market tubes again, and now we're down $314,000, and we're forced to roll down yet again, but this time we have to sell, that's right, 365 puts to get to barely positive cash flow, and now our capital requirements have ballooned to $6.5 million. So let's just summarize to show you how insane this got. We started out with 10 puts and a capital requirement of $255,000. And by the time we're done, we were selling 365 puts, and our broker was requiring us to put up over $6.5 million in our account to cover our risk. Now that was the final roll, and at the end of the day, you would have in fact made money on the trade. The market did bounce at that point, and the trade would have actually been very slightly profitable when the options expired. But that's obviously not the point. The real point should by now be fairly obvious. You started out with a nice idea to buy your wife or girlfriend some jewelry on Valentine's Day, and you end up, before the final roll, down $314,000 on the trade and having to put up $6.5 million just to more or less break even on the trade. I want you to close your eyes and just imagine the slow motion train wreck of this trade. Even if you did have a spare $6.5 million lying around, do you think you would have exposed it to this trade when you were down $314,000 and had to sell 365 puts just to put yourself into a position to basically break even on the trade? Well, allow me to bring you into the real world. No one has no emotions, and no one has an infinite amount of capital. And even if you did, I have never met the person who would just keep digging a deeper and deeper hole for himself, even though it's an undeniable fact that if you threw enough capital at this trade, you'd always eventually make a little bit of money. But you're human, and you do have emotions, and you certainly don't have unlimited capital. And so at one point, you would cry uncle because you wouldn't be able to take the risk and the pressure of this trade. If you can't intuit that from this presentation, then just take my word for it. You would have bailed out at some point in this process and taken a huge loss. So please do yourself a favor and do not ever get trapped into the thinking of options blunder number 5. I'll always win eventually if I keep rolling my short puts down, right? The irony is that it's an absolutely true statement, but it's utterly insane and impossible to tolerate in the real world. Not the fantasy world of no emotions and unlimited capital. Professional traders would never fall into this trap, and you shouldn't as well. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video. Don't worry. Or you could just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And one more thing, please don't forget to click on the subscribe button right now so you won't miss the next episode of Huge Options Trading Blunders and all the other free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.